Okay, so I'm going to run through some questions that are pretty standard questions. These are from the 2022 exam. And so there was a scenario, the first one, and it deals with dependency. And so it states that Chris's husband, George, moved out of their home in February of 2022. She had no contact with him since he moved out. Chris and George are not legally separated. Chris has one child, Mary, age 9. She'll claim Mary as a dependent on her 2022 tax return. Chris is 31. Chris earned $36,200 in wages, received $50 in interest. She was out of work for a month and received unemployment of $1,800. Now, Chris paid all the costs of keeping up her home. She provided over half the support for Mary. They're U.S. citizens and have valid Social Security numbers. They lived in the U.S. all year. So the first question was, what's the most beneficial of the following statuses that Chris is eligible to claim on her 2022 tax return? Is it single, married filing separately, qualifying surviving spouse, or head of household? I mean, we know that she's not a qualifying surviving spouse because her husband is still alive. Single? Well, she can't claim single because they're still married. So is it married filing separately or head of household? Now, before even looking at single or qualifying surviving spouse, what we should have done, I should have done, is gone and looked it up and determined what it truly is, not make a guess. So what we're going to do is use one of our main resources. We have two main. One is the publication 4012, and the other is the qualifying child or qualifying relative tool. So what I'm going to do is use the qualifying child or qualifying relative tool, which is pretty simple, and show you exactly why. So I'm going to stop this slide. I'm going to create another slide, the next one. I'm going to put the qualifying child or relative resource tool on there, and I'm going to see if I can draw and walk through the decisions to determine what's the best choice for Chris to choose in terms of filing status. Okay, so I'm a terrible artist. I can't even draw stick figures, but I am going to try to walk through this qualifying child or relative resource tool. Again, the 8-page document that all tax counselors should have. If you don't have one, check with your coordinator. And so we're going to start at the beginning, and we're trying to determine what the best filing strategy would be for Chris. So start here. Was the child a U.S. citizen? Yep, they were all citizens. Was the child your son, daughter? Yeah, well, you can stop there. Was her daughter. Was the child under age 19 at the end of the year? The answer is yes. Was the child younger than you? The answer is yes. Except for temporary absences, did the child live with you for more than half the year? She lived with her the whole year. So the answer is yes. It says go to page 2, box 16. So we go up here. Was the child a qualifying child for any other taxpayer? That says, except for temporary absences, did the child live with any other close relative more than half the year? The answer is no. Her dad was not there starting in February. Is the child filing a married filing joint tax return? The answer is no. Can you, the taxpayer, or your spouse, if married filing jointly, be claimed as a dependent on any other taxpayer's return? The answer is no. Were the parents divorced, legally separated, or lived apart all the last half of the year? The answer to that is yes. Are they filing separate returns? Well, yeah, Mary says that Chris is going to claim Mary as dependent on her tax return. So they are filing separate returns. Was a child in the custody of one or both parents more than half the year? Yeah, the answer is yes. Did one or both parents or the new spouses provide more than half of his support? The answer is yes. Does a non-custodial parent have the right to claim the child's exemption? Well, we have no information on that. It doesn't appear as though the father has any rights. Did the child provide more than half his own support? The answer to that is no, which leads us to this blue box. And it says, This person is your qualifying child and dependent. 4. So it is Mary is Chris's qualifying child. Now there's a second question here, and it says, so what's the best way? It shows here head of household or qualifying surviving spouse. So her husband's not passed away, so head of household. That was the correct answer. Now, there's a question, the next one, that says, based on information provided, Chris qualifies for the Earned Income Credit. Well, it says down here, EIC, and dependent for EIC, if both taxpayers and child have valid SSNs, they do, and the taxpayer is not the qualifying child or not a taxpayer. She is. So she could try for the EIC credit. The issue is, the Earned Income Credit, does she qualify? I don't know enough. So the place to go is to publication 4012, and that's where we're going to go next. So here we are. This is the 4012. I know enough so that you click on the pen again. I know enough when I go into the 4012 that EIC is in tab I. So I just went in the front, saved time, clicked on tab I. I went to tab I, and over in tab I is a summary of EIC eligibility requirements. So we can look at this table and hopefully determine if Chris can claim the EIC. So here's part A, rules for everyone. I apologize with the small type here. Taxpayers and qualifying children must all have SSNs that are valid for employment by due date. Well, they all have valid SSNs. You must meet certain requirements if you're separated from your spouse and not filing a joint return. Look at that number 4, little footnote number 4. So here's a lesson. Always check those footnotes. The footnotes may make a determination one way or the other. And so if we go down to number 4, which is way down here, again, apologize for the small print, it says married taxpayers who don't file a joint return can claim the EIC only if they had a qualifying child living with them for more than half the year. Well, Chris did. Mary lived with her for the whole year. And either lived apart from their spouse for the last 6 months of the year, which she did, or are legally separated, according to the state, under legal separation, live in the same household. Well, none of that. So Chris is good to go, according to that. Must be a U.S. citizen. They all were. Can't file Form 20 related to foreign income. Nope. Didn't say anything about investment income that she had. Can't be the qualifying child of another person. Yep. Part B, rules if you have a qualifying child, which Chris does. Child must be meet the relationship age, residency test, and joint return. Child doesn't have to be your dependent. That's number 2. Return the child, the joint return. Cannot file a joint return. She's not. Qualifying child can't be used by more than one person to claim it. She won't because, Chris is claiming in a household. And the taxpayer can't be a qualifying child of another person. So, can Chris claim Mary? Based on that, does she qualify, for the Earned Income Credit? The answer is yes. So I'm sure in that last slide that you all jumped up out of your chairs and said, wait a minute, you missed something. And I did. What I missed was part D over in the right column. So I checked everything in part A for everybody. I checked part B because Chris had a qualifying child. Part C is if you don't have one, but over in part D, that's where we have to have an income and AGI check. And so if you're not careful, you might miss something. In this case, Chris's earned income, what she earned total was $36,200 in wages, $50 in interest, and then she got unemployment for $1,800. That would have to all be added together to see if she exceeded the limitations for a person with one qualifying child or a couple with one qualifying child. In her case, the limitation is $46,560, which she did not exceed. But again, be very careful. Some of these credits, and in some areas, there'll be multiple tables. There'll be a lot of information. You just have to weed through it to see if people qualify for credits and so forth or not. So here's another way to traverse through the rules and limitations and to see whether somebody would qualify for the EIC. This is also in the 4012. And it says general eligibility rules. First thing would have checked using this method is income. You can see in step 1 where they're checking income. If yes, go to step 2. No, you can't claim it. So this is a better, it's an alternative way to check. Be as thorough as possible when looking for exceptions. Another question that's always likely to be on the advanced tax exam. This one deals with Jenny Smith. Jenny has a health savings account. There's a lot of information here about how much was contributed to it and so forth. The question number 8 on last year's exam was, what's the total unreimbursed qualified medical expenses reported on Form 8889, Part 2? So that's where they would show, and you can go look at 8889, and that's where they would show distributions for her or medical expenses. The key word here is qualified. What is qualified? What are qualified expenses? She shows her unreimbursed expenses, 8 visits to a physical therapist for $400, unreimbursed doctor bills for $900, prescription medicine, placement of crown, over-the-counter medication, and gym membership. Well, I don't know offhand personally which one of these qualify or not. Some of them I think I do. I don't know all of them though. So how are we going to resolve this? Well, the way we're going to resolve it is to go to our resources. And in this case, in publication 4012, there's information on health savings accounts and what are qualified medical expenses. So let's go take a look at that. So I think I'm a pretty smart person, and I go into publication 4012 and I see under health savings accounts qualifying medical expenses. And I note in the box at the top that it says, except for health insurance premiums, qualifying expenses include all medical and dental expenses, deductions allowed in Schedule A. Also says down here, in addition, over-the-counter products and medications are now reimbursable without a prescription. But I note as well, so remembering that and noting that they said, what's allowed in Schedule A? I'm going to go check Schedule A. So here's Schedule A, and here's Jenny's unreimbursed expenses. And we know that visits to a physical therapist, the doctor bills, prescription medicine, replacement of crown is dental, which they said was fine. Over-the-counter medication, we just saw that over-the-counter medication was a qualified medical expense. But gym membership, well, over on the side where it says can't include, there's what you can and what you can't, where it says expenses for your general health, even if following your doctor's advice, such as health club dues. There you go. So gym membership cannot be claimed as a qualified medical expense. So the answer to this question was $3,040, which was number C, or letter C, last year. So this is a question that shows up every year on the advanced tax exam. It's bound to be on this year's as well. This is from last year, from 2022. So Alice, age 58, is single. She owns her own home. Has information there. Only income was $46,000 W-2 wages. Linda, age 24, and her daughter Nancy, age 4, moved in with Linda's mother, Alice. So Alice is the grandmother. Linda is the daughter of Alice. And Nancy is the daughter of Linda. So you've got a grandparent, daughter, and grandchild living in the same house. That's after she separated from her spouse in April of 2020. So Linda's only income was $25,000 in wages. She provided over half of her own support. Nancy didn't provide more than half of her support. Linda will not file a joint return with the spouse, and all individuals are U.S. citizens with valid Social Security numbers. No one has a disability. They lived in the United States for a year. So for the purpose of determining dependency, Nancy could be the qualifying child of only Alice, the grandmother, only Linda, the mother, either Alice or Linda, the grandmother or mother, or neither Alice or Linda. So once again, we're going to use it says qualifying child of who, so we're going to use the 8-page resource tool, which we'll do on the next slide. Okay, so here we are again. Qualifying child or relative resource tool. We're going to step through, and as we go through, we're going to use Linda, the mother, and we're going to walk through as though we were she. We start here. Was the child a U.S. citizen? It says that they all were. Yes. Was the child your son, daughter? Daughter, yes. Was the child under the age of 19? Yes. Was the child younger than you? Yes. Except for temporary absences, did the child live with you for more than half the year? Answer is yes. Now we go over to page 2, box 16. Was the child the qualifying child of any other taxpayer? So it says, did the child live with any other close relative, for example, a parent, grandparent, uncle, more than half the year? The answer to that is yes. She also lived with a grandmother for half the year. Would you win the tiebreaker? What? What is a tiebreaker? Don't know. Well, so I look, as I would in any document, to see if there's any explanations of terms. And it turns out that in the qualifying child or relative resource tool, they have definitions, they have meanings for terms. On the next slide, we're going to go back to page 7. Starting on page 6 are the meanings, the definitions, if you will, of terms. But I'm going to show you page 7. And on page 7, we'll see what a tiebreaker means. So here we are, we've moved to page 7 in the qualifying child or relative resource tool to where they have helpful definitions. And they're alphabetical, and down towards the bottom is tiebreaker rules. Number 1 says if only one of the persons is the child's parent, well, that's Linda. The child is treated as a qualifying child of the parent. That's Linda. So Nancy is treated as Linda's qualifying child. But it says, see also Rule 5. Rule 5 in the red box says, if a parent can claim the child as a qualifying child, but no parent does so claim the child is treated as a qualifying child of the person who had the highest AGI for the year, but only if that person's AGI is higher than the highest AGI of any of the child's parents who can claim the child. There's only one parent who can claim the child here. By the way, I went through, and the separated spouse cannot claim the child. So if the child's parents file a joint return with each other, the rule can be applied by dividing the parents' combined AGI equally. Now at the very bottom too, it says, subject to these tiebreaker rules, you and the other person may be able to choose which of you claims the child as qualifying child. So number 1, Linda can claim Nancy as a qualifying child because she's the child's parent. If she chooses not to, just outright says, I'm not, then the grandmother could choose her as Nancy as her qualifying child. And she has the highest AGI in the home. 46,000 versus 25,000. But at the bottom, it also says, you and the other person may choose which of you claims. So Linda could just tell her mother, Alice, I'm letting you claim Nancy as a qualifying child. So the answer is both Alice and Linda can claim Nancy as their qualifying child. In general, there'll always pretty much be a question on gambling winnings. It's always the same, just about where they'll ask the question, like Ellen here. She's 48 years old, files single. Her adjusted gross income, which includes gambling winnings of $2,000. She has $3,000 in gambling losses. So what amount of gambling losses is Ellen eligible to claim as a deduction on a Schedule A? Well, your gambling losses can't exceed your gambling winnings. Pretty straightforward. You can find that in 4012. You'd go and look up income, look for gambling, and then you'd find it. Gambling shows up. One of the reasons I wanted to mention it isn't so much for this example. It's to say it falls under, sorry, other income. So you got to look closely to find it. Uh, in terms of the answer for this, what amount of gambling losses? Well, the answer here is $2,000. Your losses, in terms of a deduction, cannot exceed what your winnings are. You only claim up to the amount of your winnings against losses. So the answer is C, $2,000 here. So this is an example of a question 20 here from the 2022 exam, that is one where you need to go and check and see what qualifies, what doesn't qualify, where all the qualifications are. And generally, they're all in publication 4012. You just need to learn how to navigate through there to find the information you need. So this is one where it says which is not a qualifying expense for the American Opportunity Credit. And I sit there and go, hey, is that the one where you can be a felon, or you can't be a felon, or is that, how many years is it good for? Is it 4 years, 5 years, lifetime? Don't know. Don't memorize. Need to go and look it up. So I did. And what you'll see here are 3 different sections. So you can be all over the place in the 4012. It's pretty well organized, but in general, they're all within the same tab. And on the left here, there's a red box that says what education qualifies, some other conditions, and so forth. Then there's another place, another page, where I found the one on the right, where it says what expenses qualify besides tuition and required enrollment fees. Well, it just told you right there what qualifies besides tuition. So tuition qualifies. It also says course-related books, supplies, and equipment. Well, B is required course-related books. D is required course-related equipment. C is tuition. Those all. And then there's a link. It says see page J10. So I saved you the trouble. I went to page J10, and it says what are qualifying expenses. It basically repeats it. It says course-related materials, books, supplies, equipment needed, course to study, and so forth and so on. Has some good information about computers and peripheral equipment in the bottom of that section. But you see anywhere where it says parking passes are covered? So, in fact, parking passes are not covered by the American Opportunity Credit. So that's the answer. The answer was A, parking pass. So here's an example, another question 24 in the 2022 exam. Which of the following can be claimed as his business expense in Joanne's Schedule C? Joanne's self-employed, delivering food for delicious deliveries, and she kept receipts for the following out-of-pocket expenses. $100 for tolls, $120 for car washes, $150 for tickets for legal parking, $150 for snacks and lunches Joanne consumed while working. So I don't know all of them. I don't know everything in terms of memorization. So I went out to the 4012 to try and determine which ones or which one of these, to answer the question, can be claimed. And walking through, I noticed that it said see publication 334, which is in red here, Tax Guide for Small Business for more details. So I went out there, and lo and behold, in that publication, there was a table, and in the table, you can see at the bottom, actual car expenses include the cost of the following items: depreciation, garage rent, gas, insurance, lease payments, licenses, oil, parking fees, registration, repairs, tires, and tolls. There's tolls. So tolls can be claimed. That means the other 3 can't. Car washes has been a contentious issue with the IRS and taxpayers, and it's gone back and forth over the years. They finally came out and said, no, you can't claim car washes. Tickets for illegal parking, obviously. Tickets, if speeding, illegal parking, no, can't claim those. Tolls is good. Snacks and lunches, another one where if for meals, business meals, that's changed over the last several years, but business meals are meals that you can charge. Those would be for if you were meeting for business, official business with someone. Let's say you're with one company, you're meeting with someone from another company. Snacks and lunches, if you were an Uber driver and you had water that you handed out to people, and you had snacks that you handed out to people, then as part of your business, you're not consuming, your clients are consuming, you could probably, you could charge that. But again, just general snacks and lunches while you're doing your thing, making deliveries and so forth, that is not deductible as an expense.